Ever wondered how your money can work for you? Well, it's all about investing. You see, when you invest, you're essentially buying a piece of the future. There are many ways to do this, from buying properties to starting a business to trading stocks. But there's one option that's been gaining traction lately, and that's mutual funds. They offer a unique blend of risk and reward, and can be an attractive option for many. So, could mutual funds be your answer? Let's dive into it. First off, what exactly is a mutual fund? Allow me to paint a picture. Imagine a large pool of money contributed by numerous investors, just like you and me. This pool is then managed by a team of experts known as fund managers, who use this money to buy a wide variety of stocks, bonds, or other assets. This, my friends, is a mutual fund. The beauty of a mutual fund is in its diversity. Instead of putting all your money in one basket, a mutual fund spreads it out across a wide array of investments. This means that even if one investment doesn't perform well, others might. The concept here is simple. Don't put all your eggs in one basket. Now you might be wondering, how is a mutual fund different from other investment options? Well, let's compare it with investing directly in stocks. When you buy a stock, you're buying a piece of a single company. But with a mutual fund, you're buying a piece of a whole bunch of companies or bonds or other assets. It's a bit like going to a buffet versus ordering à la carte. Mutual funds also offer a level of professional management that individual investors often can't afford on their own. The fund managers do all the heavy lifting, making the investment decisions based on thorough research and their understanding of the market. So you can sit back, relax, and let your money work for you. But it's not all sunshine and rainbows. Like any investment, mutual funds come with their own set of risks. The value of your investment can go up and down, depending on how the assets in the fund perform. And while diversification can help reduce risk, it can't eliminate it entirely. Now that we know what a mutual fund is, let's weigh the pros and cons. Stay tuned as we delve deeper into the bright and flip sides of mutual funds in the coming scenes. What's so good about mutual funds, you ask? Well, let's start with the big D, diversification. Imagine you're at a buffet with a wide variety of dishes on offer. Instead of piling your plate with just one item, you'd probably pick a little of this, a little of that, right? That's essentially what diversification is all about. By investing in a mutual fund, your money gets spread across different types of investments such as stocks, bonds, or commodities. This way, if one sector of the market dips, your entire portfolio doesn't go down with it. It's a bit like not putting all your eggs in one basket. Now let's move on to the next advantage, professional management. When you invest in a mutual fund, your money is managed by financial whizzes who eat, sleep, and breathe market trends. These professionals have years of experience and a wealth of knowledge that they use to make informed investment decisions on your behalf. It's like having a personal financial advisor without the hefty fees. Last but not least, we have affordability. Mutual funds make the financial markets accessible to everyone, regardless of their budget. You don't need a fortune to start investing. With mutual funds, you can start with as little as a few dollars. This makes it easy for anyone to get a piece of the investment pie. But wait, there's more. Mutual funds also offer flexibility. You can buy or sell your mutual fund units at any time based on the fund's net asset value. Plus, there's a whole variety of funds to choose from, ranging from sector-specific funds to balanced funds and more, so you can pick and choose based on your financial goals and risk tolerance. Sounds pretty great, right? But like anything in life, mutual funds have their downsides too. Now, let's flip the coin and see the other side. Mutual funds, like anything else in the financial world, have their downsides. They're not the perfect fit for every investor. Let's dive into these darker waters, shall we? First, fees. Mutual funds come with a cost. This is typically a percentage of your investment known as the expense ratio. While it may seem small, sometimes as low as 0.25%, over time, it can eat into your returns. Plus, some funds charge additional fees for things like buying or selling shares. These costs can add up, and there's something you need to keep an eye on. Next up, control. When you invest in a mutual fund, you're putting your faith in the fund manager. They make the decisions about what to buy and sell and when. You, as an individual investor, have little say in these matters. This lack of control can be frustrating for some, especially those who like to be hands-on with their investments. And lastly, the potential for losses. Mutual funds, like all investments, come with risk. The value of your investment can go down as well as up. And while mutual funds are generally considered to be less risky than individual stocks, they're not immune to market downturns. A poorly performing fund can lead to losses, sometimes significant ones. So, while mutual funds can be a great way to diversify your portfolio and potentially earn a return on your investment, they're not without their drawbacks. It's important to weigh these against the benefits before making a decision. Remember, investing is not a one-size-fits-all proposition. What works well for one person may not work for another. It's all about finding the right fit for you and your financial goals. So, it's not all roses and sunshine with mutual funds. Let's wrap it up. So, how do we balance the good with the bad? That's the million-dollar question, isn't it? We've explored the landscape of mutual funds, dissected their advantages, and scrutinized their disadvantages. Now, we're left with the task of weighing these aspects against each other. But don't worry, it's not as daunting as it sounds. Let's first revisit the bright side of mutual funds. They offer diversification, professional management, and liquidity. These are compelling benefits for anyone, especially those who are new to investing or don't have the time to manage their own portfolios. Diversification spreads your risk across a variety of investments. Professional management takes the guesswork out of picking stocks, and liquidity ensures you can access your money when you need it. On the flip side, mutual funds also come with their set of drawbacks. They carry fees and expenses that can eat into your returns. Plus, the performance of mutual funds is subject to market risks, and there's no guarantee of returns. This brings us to the crux of our discussion, the balancing act. How do you decide if mutual funds are the right investment vehicle for you? It all boils down to your personal financial goals and risk tolerance. If you're saving for a long-term goal like retirement and can tolerate some ups and downs in your investment value, mutual funds could be a good fit. The potential for higher returns might justify the risks and costs. On the other hand, if you're saving for a short-term goal, or if you're risk-averse, you might want to explore other options. Remember, there's no one-size-fits-all answer when it comes to investing. It's about finding the right balance, the sweet spot that aligns with your individual circumstances. In conclusion, mutual funds can be a powerful tool in your investment arsenal. They offer potential benefits but also carry certain risks. The key is to understand these aspects, weigh them against your personal financial goals and risk tolerance, and make an informed decision. Remember, every investment decision should align with your financial goals and risk tolerance. So, are mutual funds the right choice for you? That's the million-dollar question, isn't it? The answer, as we've seen, isn't as simple as yes or no. It's a matter of personal circumstance, financial goals, and risk tolerance. Consider your financial goals. Are you saving for retirement, a down payment on a house, or your child's education? Each of these goals requires a different investment strategy, and mutual funds may or may not fit into that strategy. It's about finding the right balance between risk and return. And speaking of risk, how comfortable are you with it? Are you willing to ride out the market's ups and downs for the potential of higher returns? Or do you prefer the comfort of a predictable but possibly lower return? Mutual funds offer a range of risk levels, from low-risk money market funds to higher-risk growth funds. But remember, higher risk doesn't always mean higher returns. If you're feeling a bit overwhelmed by all this, don't worry. It's okay to seek professional advice. A financial advisor can help guide you through the decision-making process, taking into account your unique circumstances and goals. In the end, the most important thing is that your money is working for you, not the other way around. Investing isn't just about making money, it's about creating a future that you're excited about. So, whether you choose to invest in mutual funds or not, remember to invest wisely. Remember, your money should work for you, not the other way around. Invest wisely.